All right, let's talk about the NGX and look at consumer goods more specifically. I think we're going to start off with how the NGX has performed so far this month of May. As you can see, May the 2nd, it was down by 2 basis points. Another bearish activity on the 3rd, down by 17 basis points. And then bullish activity on May the 4th, all the way through to May 9th. And then yesterday, May 10th, falling by 75 basis points. So far this year, the market is up by 1.87%. That's the year-to-date return for the NGX. Yeah, as of yesterday, May 10th, 2023, 1.87%. All right, so joining us to discuss further as far as the consumer goods sector is concerned on the NGX, Fola Abimbola, Senior Frontier Analyst, Stanbic IBTC Bank. Fola, you're very welcome. Good morning to you.
Thanks for having me.
Thanks for joining. So what do you make of the NGX performance so far this month in May?
Well, I think the first thing to highlight is that there's a range of factors that are driving the performance of the NGX.
Yeah.
We have the interest rate environment. We have the fact that PFAs and institutional investors would rather take advantage of a decent risk-adjusted returns, potential returns from the fixed income market than take more risks in the equity market. We also have Q1 numbers coming out, or that came out. Performances were mixed, and mostly a lot of the sectors didn't do quite well compared to last year, and that's because of one of the reasons was the cash crunch and the tough environment. And then, lastly, there is also the fact that foreign investors are still not coming back into the country. So a lot of these things tend to hold down the performance of the exchange.
Yeah, I think if we look at the returns of the sectors, the consumer goods sector, which is what we want to look at, so 1.3% yesterday, oil and gas up by 93 basis points, industrials fell, banking and insurance. But let's stick with consumer goods. I guess starting with, I'll also look at 3 companies if we can, if we have enough time, Nestle, Guinness and Dangote Sugar, and then some news on Unilever Nigeria. But we're starting with Nestle. Looking at their first quarter performance, revenues 16% year-on-year growth. Profit before tax did fall by 10%. Profit after tax. What was the drivers here? What's your review on how Nestle performed in the first quarter?
Well, Nestle, similar to other consumer companies, what's been happening is that there's been a lot of challenge regarding elevated costs. We've also seen them unable to pass on inflation to prices as much as they would have because of the low cash liquidity in the system. So from the retail end, the end consumer does not have as much money to spend because of the cash sensitivity. So what's now happened is that they've not been able to pass on that cost. And also, you also have a situation where there's a high FX exposure. You have a lot of their payables and a lot of their debts denominated in dollars, so they have to post some FX losses. So all those combined, drove EPS lower. But in the same way, you would say that they've been able to remain resilient and grow volumes despite all these challenges. It's just the high cost environment that's making it difficult for them to grow earnings.
Now, an EPS, just for the purpose of our viewers, is earnings per share, right?
Yes.
Okay, thanks. You smart technical analysts. The FX thing, for companies like a Nestle that has a parent company, overseas, there's no assistance in them in the FX being able to get that from the parent company. That's not the case?
Well, a lot of one could credit the parent companies for supporting Nestle Nigeria because a lot of their inputs that they would have to import would be supplied by the parent company, which is Nestle SE.
Yeah.
However, as a result of that, they have to record payables on their books.
Yeah.
And because of that, if there's a devaluation, the dollar portion of those payables means that they have to post a devaluation loss because they will have to pay higher. They will have to get dollars at a higher cost to remit back to the parent company.
Interesting. So I guess the FX challenges that are in the country, this is how they flow through to these companies, right? And if we had a unified exchange rates, one single, would that help with a lot of these companies and what they're facing with the FX challenges, or does the continued devaluation continue to be a problem?
Well, so if you talk to the management of these companies, their challenge is not necessarily the fact that exchange rates keep going up. The challenge is liquidity, and the challenge is being unable to plan for the future. So if they have an estimate of where exchange rate is going to go next year, they can plan ahead and say, okay, we need to start buying more inventories now, or we need to position ourselves. But because of that lack of liquidity, and because the regulator does not seem to be giving any kind of reassurance, that seems to be where the challenge is. And that means that a lot of these multinational companies have to get support from their parent company, which means in the form of inputs, imported inputs, which means that they would have high payables on their books, high foreign exchange payables, which means that if there is a sudden devaluation, and we know the way devaluation works in this country, you can have situations where there's a 10% devaluation, and you can have some situations where there's a 50% devaluation. So all these things come together and affect their performances.
Gotcha. What about the stock? We had the stock price up there, closed a little over 1,000 Naira per share. So far this year, it's down about 5%. Do you have a recommendation on the Nestle stock price as far as, whether target price or whatever, or even recommendation, buy, sell, hold, rather?
We are quite bullish on Nestle, and we believe its valuations is cheap when you compare this with its historicals. I think Nestle's case is quite peculiar because when foreign investors come into the market, they look for quality names, and Nestle seems to be top of mind. But because of the FX situation and the lower risk appetite from foreign investors, there hasn't been that much interest in the stock, and that's what is causing the sell-off. However, one could say that the company remains resilient. The company is positioned to grow in this environment, and also its portfolio is quite favorable. So, we are quite bullish. We have a buy recommendation on Nestle, and we believe that once reforms start to kick in from the new administration, we should see some growth coming in.
Good stuff. Let's move from Nestle over to Guinness, over the brewery sector, still under consumer goods. They had a big drop in their quarter 3 results, 71 and 71.4% drop, profit before tax, profit after tax. What's up with Guinness? What's happening with them?
So for Guinness, I guess the challenge is similar across board, in the sense that FX exposure has meant that they've had to post some FX losses. They've had elevated operating costs as well. But the challenge with Guinness is its portfolio, its product offerings are actually weighed to the premium side. And in an environment like this, where the consumer disposable income is squeezed, what then happens is you see lower demand from their products like stout and spirits. And another challenge is that when you look at Guinness's portfolio, around 30% of its business is spirits and ready to drink. Now you see a situation where there is higher excise tax compared to carbonated soft drinks and also lager, and that seems to affect Guinness the more. The ability to pass on those increases is very, very limited because of these cash constraints that we had in Q1. So all this put together means that their performance wasn't too good.
Wow. Does inflation play into when you talk about consumer goods? So the challenge we're talking about your Nestle's and your Guinnesses and so on. Is that also the high inflationary environment?
Yes, but then it also depends on their product portfolio. For some companies, it's easy to pass on your cost, but for some, it's quite difficult. So if you are selling a shirt, for instance, it's difficult to increase the price of a shirt because people don't need shirts. But if you were selling things like rice or sugar or seasonings, it's more easier to pass on those kind of costs. And that's the problem that Guinness has had, because its product is on the high-end side. So the ability to pass on that increase is quite constrained.
Well, what about the whole shrinkflation thing where you're seeing drinks in sachets? Guinness can't do that.
There's a limit to which you can do that, and I guess Guinness has reached that limit. You find some of its products, particularly the gin brands, in small plastic bottles. But then if you reduce that lower than that, the utility that the consumer would get from it would be meaningless. So they've actually done that. A lot of the companies have actually reduced their pack sizes to the barest minimum. They've been doing this for years. But then there's also the cost side of it, because the cost of distributing such is also higher, because if you were to distribute several 75 ml bottles, it's almost the same cost of distributing smaller bottles. But then, there's that cost factor, but then the revenue you generate from it, because they are smaller pack sizes, the revenue is smaller when you look at it as a whole.
Gotcha.
So, but then I would say that they've reached their limit, and their only saving grace is to try and pass on the price increases. So the hope is for the environment to get better, where the consumer can afford more products and they can pass on price increases, or maybe cost comes down for them.
So GDP growth, the economy should grow, people get wealthier, and then they're able to afford more of these drinks.
Yes, I mean, that should be the story, but that's not been the case for a while now.
But for breweries, normally Q4, the festive season, isn't that when they do, well, I know that their annuals, looking at Q3 for them, which is, I think, looking at the way their own year end is structured. But for the last quarter of the year, don't they do better?
They do. But then if we look at the Q4 numbers, they actually did quite well. And that's because, first of all, we did not really have the cash crunch coming till Q1.
Yeah.
Also, there was also the campaigning, election campaigning, which helped them. But then that was offset by the challenges in Q1. So they did quite well in October to December, but January to March was.
That's why it was tough.
Yeah.
Okay, the stock closed at 70 Naira yesterday, up by about 1% so far this year. What's your recommendation on Guinness?
So we have a hold on Guinness, and we believe the environment will be very challenging for Guinness. We see it being impacted, among the most impacted among our coverage. So it's a hold.
It's a hold for now. All right, let's get another one. So we've done Nestle, that's food. We've gone to Guinness, that's drinks. Sugar, Dangote Sugar, their Q1, this good performance, or as far as their returns, for 36% return year-on-year growth for profit before tax, 44% for profit after tax. Talk to us about Dangote Sugar, and I guess how the environment they are performing it.
Right, one could credit Dangote to its kind of portfolio. I mean, its product is more staples. The products offered to consumers are more staples. Also, we have this trend in Nigeria where when there is an FX crisis, importers of products, so competitors that import those sort of commodities are affected by the FX illiquidity, and that helps a Dangote Sugar. And that's because Dangote can get FX from the official market. Unfortunately, or maybe fortunately for Dangote, the smugglers or the people that bring in imported refined sugar can't get FX from the official market, so they have to go to the parallel market, which is trading at a huge premium. So their competitiveness is not as much as a Dangote. So that's limiting competition for Dangote Sugar. That's also increasing their market share in the sense that they've been able to grow in the northern region where there's a lot of brand equity for the Dangote name. There's also that stronger demand within that region because of the population size. So that's actually helped Dangote to grow volumes. Even though they still increase prices, they were still able to grow volumes, and that translated to increased earnings in the bottom line.
What about the sugar? There's the sugar master plan from the administration. How would you the environment for sugar, because they're not the only player in the space. There's still looks like there's still a lot of imports coming in. The backward integration matter. We had the CEO of Dangote Sugar not too long ago. So how do you view that the space for sugar?
So the way the environment works is that we have almost 99 to 100% of raw sugar is imported, but majority of the sugar that we consume here is actually refined locally. So the challenge is more of the ability to actually drive productive capacity around the sugar plantations. I mean, there's been that plan, like you mentioned, that has been rolled out for years, but there's been challenges with the likes of Dangote having issues with land, with productivity. So if you look at yield per hectare for sugar, it's probably around 3 tons per hectare, compared to the global average of around 15 tons per hectare. So we still have a lot to do, a long way to go in terms of productivity. And then there are other challenges in terms of how you would bring in yields and how you would grow your plantation such that you can maximize your yields. And also the area under cultivation seems not to have grown significantly over the last years. And one could also say that there's a disincentive for that backward integration, because it feels like it's much cheaper for you to import raw sugar, refine it, and sell it locally than for you to go through that investment phase, because it costs a lot of money. You have to look for the dollars, you have to invest locally, you have to deal with local situations, you have to deal with any form of attacks that might happen on your farms. So all those things come together and could affect your yields. But then it's easier for you to just import and just sell locally.
Gotcha. So all this being said, thank you so much for the breakdown. Looking at this stock, what's your recommendation?
We think the environment is favorable for Dangote, and we have a buy recommendation on Dangote Sugar, so we are quite optimistic and we believe it can grow in this environment.
Real quick, Unilever announcing that they're going to exit, I think, the skin cleanliness and one other sector. What's the story there?
So they're trying to exit the skin cleansing and home care sector.
Okay.
Now, the issue with them is the FX as well.
Yeah.
I mean, there's been a lot of questions about, are they planning to leave Nigeria altogether? But the management has come to clarify and say no. The challenge is that there's been a lot of FX reliance on those particular categories.
Yeah.
So what happens is that because of the high FX cost of manufacturing in those categories, they've been a drag on their operating profits. So if you look at their operating profits of those categories, they've been negative, and they've been dragging performances of the seasonings, of the other brands as well, which are doing quite well. So they're saying that once they take those ones out of their portfolio, they can see sustainable and progressive growth.
Excellent stuff. Fola Abimbola, a senior frontier analyst, Stanbic IBTC Bank. Thank you so much for giving us a deep dive on Nigeria's consumer goods sector. Really appreciate your time.
Thanks for having me.